Our next presenters are with Six Flags Entertainment Corp. as we enter what might be described as the most exciting and fun presentations of the day. As we move into some of the amusement parks, it's my pleasure to have Executive Vice President, Chief Financial Officer, Sandeep Reddy, as well as Senior Vice President of Investor Relations, Treasury and Strategy, Steve Purtell from Six Flags. Thank you for joining us this year.
Thank you, Stephen. Welcome. Happy to be here.
So Six Flags has managed through the past year, I think, given all the challenges, remarkably well. And you've also outlined a bit of a transformation plan through that entire process. But perhaps you can just talk about some of the key learnings that you've had through the past year as you think about positioning the business going forward.
Yeah, and I think what's really interesting is I'll go back to even past. I mean, I've been in the company about 11 months, almost a year now, and so I joined in the middle of the pandemic, or right when it started. And I think even before I'd started, Mike Spanos had taken over a few months before that, and he'd identified a number of areas where there was opportunity. So the seeds of transformation were already planted even before the pandemic had started. And really what we'd identified was, when we looked at the last few years pre-pandemic, we'd seen a bit of a stagnation in the business. Attendance was stalling a little bit, and revenues were really being outpaced a little bit by costs, so margins were basically shrinking a bit. And there was definitely the case for a transformation to be actually launched. And so the initial thoughts were already seeded, I think, in a February earnings call in early 2020, pre-pandemic. And then, well, the pandemic came. And then I think Steve, Mike, Lenny at the time got together and showed up the financing of the company, made sure we had enough runway, did a great job. And I think that was back in April of 2020. And we took a bit of a pause in those few months until we actually got somewhere towards May. And then we just looked at the work that had been done initially on the diagnostic for transformation, and it still made sense to actually launch it. So by the time I came around into the company back in late June and into early July, we really just restarted the work on transformation. And so what's really happened over the last 12 months, it feels like 3 years, more than 12 months, but we've done a lot. We've done a ton to actually identify that transformation plan, the elements of it, and we've actually learned a lot about our business in the process. And the transformation plan has helped us zone in on the fact that our guest experience was where the maximum unlock was going to happen. So everything in our strategy is pivoting around modernizing that guest experience and using technology to do it. And I think apart from that, I think there's definitely value generation that is going to come from cost and productivity savings. And we called out $80 to $110 million in transformation value. Half of that is fixed cost independent of attendance. And that's pretty much in our control, regardless of what happened with the pandemic, and work on that's been ongoing. We're expecting to get $30 to $35 million of that this year. And then really, as we move into next year, the full amount would be expected to be realized. And the remaining part is more tied to attendance. And as attendance begins to revert back to where 19 levels are, we expect to realize that remaining value. Some of it is $30 to $40 million of that value is based on revenue, and the remaining part of it is based on variable labor, where we're looking for productivity. And I think we'll have more chance to talk about labor in general and some of the pressures on labor that have been sustained. So that's really the learning, which is there's a big opportunity on guest experience, but a tremendous opportunity on the operating model to generate value.
So I guess going into the operations a little bit more, I guess, can you go into a little bit more detail about how you are evolving the operations to better service various types of customers? I know that you were moving towards a little bit more of a single day, at the same time that you're growing season pass and membership. So how does that change the way that you think about the operations of the business?
Yeah, I think going back to what we talked about in the beginning, when I said in the last 3 years before the pandemic, we'd seen a bit of a stalling. What the company done extremely well in the years preceding that was been very innovative in coming up with a season pass model, which it had launched early in the early part of the previous decade, and then actually bringing in a membership model, which was layered on top of that, and together those formed the active pass base. But while we were driving the business and attendance towards those cohorts, we really probably didn't fully appreciate the value of the single day ticket holders, and we had lost a bit of momentum with single day ticket holders. So what Mike identified when he came into the company late in 2019 was we probably lost too much traction on the single day ticket holders, and that's the bottom of the funnel, who essentially eventually become active pass base if they like what they're seeing. And so we started the work in the early part of 2020, pre-pandemic, to drive more single day ticket volume. But right from the beginning, Mike was very clear, and I think I've reiterated the same thing. Single day tickets are an and, not an or. So it's continue to build the active pass space, but grow single day tickets in addition. Because we'd actually lost traction in the last few years, single day tickets have actually been outpacing active pass space. But we're now in a place where I think as time goes along, we should see growth in both cohorts. And that's what we're actually focused on doing. And the revenue management team that we put in place is engaged on ensuring that we get growth from both cohorts.
I guess one follow up on that. So what exactly do you think was driving that lost momentum in single day, and what explicitly do you think is going to not only I mean, it has been accelerating it, but will sustain that momentum going forward?
Yeah, I think I wasn't here, but I think that when I look at what has historically been done with the prior management team, there was a big focus on driving active pass base. It wasn't necessarily to exclude the single day ticket holders, but the pricing incentives on a relative basis definitely favored choosing active pass base. So it wasn't really necessarily priced at perhaps the right value for single day ticket holders, which is why you probably saw a bit of a drop off. What we've done is we've redressed the balance. It doesn't mean price decreases. We just redressed the balance between single day tickets and active pass base. And you see that the per caps are actually pretty robust in the last few quarters. And so we're really happy with the progress that we're making on this. And we'll continue down the path. We'll continue to iterate as time goes along.
That's interesting. And one of the things that we heard from one of our panels yesterday and a lot of the companies was that management teams are shifting a little bit from being on defense to now moving to offense as it relates to the capital structure and capital allocation. Can you just talk to how the experience might have impacted how you think about the right leverage and liquidity levels, and then how that might even play into future investment and or acquisition opportunities?
Yeah, I think and on the February call earlier this year, we laid out our capital allocation priorities. And I'll say the key about this is we outlined our strategy, and our strategy is really about profit from the core. And there's so much value that we can get from the underlying assets in our business that's why we took transformation as the first cut in April when we talked about value. And I think strategy is more of completing transformation and kind of building on it. And that's really what we're talking about. So to do that, the first priority for capital allocation is investments in the core business. And we need to ensure that we're investing sufficiently in the core business. And this means making sure our park infrastructure is up to date. We did talk in the February 2020 call about some deferred asset maintenance that we identified which need to be taken care of as we went through. It's not insignificant, but at the same time, I think it's really important for the guest experience to address it as we go forward. There's a tremendous opportunity to drive per caps, and part of transformation was the revenue opportunity was expected to come from culinary and retail. So IPS is a big piece. So ROI capital to be invested to deliver that IPS experience is super important, and we'll actually prioritize that as well. And then right capital or marketable capital is also super important to bring guests to the park and get them excited about it. So we'll continue to invest in that too. And everything's actually folded into an envelope of 9 to 10% of revenue, which has been close to our historical run rate. We may just rebalance that a little bit as we go along, as we take care of some of that asset maintenance that I mentioned. But I think overall, that's the first use of capital. Second is, unfortunately, with the pandemic, with what happened last year, the balance sheet got a bit over-levered. And so we want to get back to our 3 to 4 times leverage ratio, adjusted based on adjusted EBITDA. And so I think that's the second priority once we generate the cash organically through operations to get that back in line. And a very distant third is M&A, a very distant third, just to be very clear. And so we want to take care of our core business, and then we'll see if there's opportunities to consolidate transformation is completed. That's interesting to take a look at. We don't comment on any specifics, but it's not a priority at this point. It's a very low priority. And then, of course, return of capital to shareholders is the fourth, which if we don't really have opportunities for M&A, then that's an option too if cash flow is very strong, which we believe it will be as time goes along.
Fair enough. Turning to the recovery, I know that last quarter you highlighted improving attendance trends throughout the period. How do you think about the sustainable path going forward, given there was some moving parts around spring break and operating days?
Yeah, I think, look, pent-up demand is extremely strong, and that I think continues to be the case. And if anything, it's actually getting better because the number of cases that are actually in the country are getting better and better every day. I mean, I just look at this comparison to 3 weeks ago, and it seems like in the early part of the year, we were going at the rate of half of 3 weeks ago. It started happening again after taking a bit of a pause in March, April. And so that's a very encouraging sign in terms of where things are going. Vaccinations have helped. I think we still have a fairly decent cut of vaccinations in the nation. Probably not as high as I was expecting, but it's still, the case count's very important. So that confidence is there, and guests are actually interested in getting out. And I think we're right now in the heart of the summer season where pent-up demand is there. It really, our business is so significantly Memorial Day to Labor Day that this is game time. But I think everything we see from surveys, et cetera, points towards there is huge demand, and we should be actually seeing that demand manifest as we go along.
As a follow-up there, just thinking about pricing, I know that across the leisure space, we've heard about very strong margins and flow through upon reopening, gaming, resorts, timeshare. How are you thinking about leveraging pricing and promotions to drive revenue in a reopening? And are you finding that that pent-up demand is maybe alleviating the need for certain types of marketing or promotions?
Yeah, I'd say the pricing and promotions ties back to what I talked about earlier about you got to make sure you got the right price value. So that price value equation needs to be maintained, and we will actually keep the integrity of that price value equation. And so we saw results of that both in Q4 and Q1. We intend to keep down the same path as we go along, because what we don't want to do is unnecessarily raise the prices where it doesn't make sense from a price value perspective to the guests. We want to keep that integrity. And really, as long as your prices are fair and the assortment is interesting, the guests tend to spend a lot in park. And we saw that evidence based on what we saw in Q4 and Q1 on the per cap spends in park as well. And so we think there's going to be a halo effect because of the propensity to spend and the disposable income that's in the consumer wallet as we go through, and that should manifest as well. So overall, as far as we're concerned, pricing and promotion isn't necessarily an incremental lever. It's a normal operating lever that we'll continue to pull. But I think the part that you mentioned about media advertising is, I talked about this on the April call and the previous call as well. We will do marketing because there's two elements to marketing. One is to drive demand in the short term, but the other is to make sure you have a share of voice and the brand messaging out there. And I think that's super important for the medium to long term as well. And so as far as we're concerned, last year was a year where we didn't really spend that much in media because of the circumstances, but you don't really want to skip 2 years in terms of getting your share of voice out there. So we will make sure that we invest. We talked about doing it to match when the demand is expected to come, and that should be the expectation.
So I guess a couple follow-ups on those comments. I guess the first is just when you talk about price to value, what typically drives that? Is that relative to other entertainment options? Or are you referencing that versus season passes? And then as I hear your comments, it sounds like you're going to continue with some level of marketing to make sure that you're still having your share of mind or voice. Does that mean that where we could anticipate seeing greater variability of results will be in the in-park spend in particular?
Yeah, no, I'd say what I would say on the pricing front is when I talk about relative value, I'm more referencing it within the different cohorts that we sell to active pass base versus versus a single day ticket, it was out of kilter 2019 and prior because we probably made the active pass base a little bit more valuable in terms of relative value than the single day ticket, and that's why we probably lost a bit of volume on single day ticket. So we're bringing that back into balance. But all of the pricing should be based on perceived value to the guest. And so whatever it is, those levels also need to be taken into consideration. And that perceived value should be relative to what experience we're offering. So it doesn't really matter what somebody else is offering. If their perceived value is different, they should be pricing differently. So we're not as concerned about that as about the value that we're able to provide our guests, because our brand is very strong, and the pricing that we deliver should reflect that value that we have in the brand. And so I think from a media standpoint, we'll continue to invest as we need to make sure that share of voice is maintained. I don't necessarily see huge variability in the cadence of that media. It's going to be matched more with demand as we go along, it should be very similar to what we talked about when we discussed our transformation initiative. And I think we mentioned 3 to 4% was historically what we'd spend. We said like it could go up to 4 to 5 because we want to make sure that we're really investing behind media.
And just remind us, who is the typical kind of single day customer, and is that different than the season pass customer? And I guess as you said that you had gotten a little bit off kilter, had that changed over time, that discrepancy between them?
Yeah, I think we're a regional entertainment provider, right? So most of our guests come from 100, 150 mile radius from around us. And if you take the top DMAs in America, that accounts for about 200 million in population. If you take our unique visitation, we're probably 10% of that across the entire universe. So there's a big amount of population to draw from in terms of what business we can actually do. And if that's the case, what we have is, if it's a 150 mile radius, somebody who's buying a single day ticket may be making a trip out of 120 miles, 150 miles. And that's a one visit type thing where they're not quite sure they're going to keep on coming back week after week to experience it over the summer. They may just make that one trip. If you make that price unattractive for that guest to actually buy the single day ticket, they may not want to go and buy a season pass. And you lose out on the business from that single day ticket. That's a little bit of what probably happened towards the latter part of the last decade. And that's what we're trying to avoid. We're trying to make sure we get that guest and as well as the guest who's basically interested in multi-visits to the park. And that's part of the active pass base.
So sticking with maybe the long-term trends of the industry and your business, you discussed the transformation initiatives and walked through some of the cost side as well as this shift in single day versus season. But let's talk about the guest experience and the revenue enhancements. What does the guest experience of the future look like? And what are the investments that you still need to make sure that you can provide that experience?
Yeah, I think the guest experience of the future is going to be a lot more seamless than it is today. And it starts with simple things that came in during the pandemic and even since. Like the website that we had was very clunky. And so it became a friction point versus an enabler of the transactions. So the mobile site's been completely upgraded, and it's a continuous process where we improve the user experience and the ability to complete a transaction in a much more seamless fashion. Things like mobile ordering, which we actually introduced during the pandemic, are an ability to actually do much more contactless transactions, and actually increases transaction size and ease of completion of transactions. And that's basically rolled out in a pretty big way now, because pretty much all our domestic parks are already doing it. Contactless entry into the park during the pandemic, because we had temperature screeners and security screeners that were more automated. We actually sped up the process of entry into the parks. We probably don't need to do temperature screenings for much longer, but the contactless entry really increases the amount of time in the park where people don't stand in line waiting to get into the park. So things like this are things that are operational enhancements that have already been made. And then we also talked about a CRM investment that we're making. That investment's part of the investments that we talked about, the $70 million that we're making investments on, including technology. And we don't expect that the ongoing technology cost is going to be outside of the 9 to 10% and the operating expenses that are included in our $530 to $560 million EBITDA baseline. So we feel that all that's funded in terms of what's coming. And a big part of what's going to come from CRM eventually is a personalized journey for the guest, because we're going to have information about their visitation preferences, their activities in the park that they spend their time on, and we're going to be able to customize a journey for them, or let them actually choose what journey they'd like to customize for themselves when they come in. So there's a lot that's in there, and it gets better incrementally over time, as opposed to like a big bang and you're there.
I know when we first were chatting when you had first started that there was some discussion around the international appeal and presence. How do you think about that as a longer term opportunity, recognizing that right now, international inbound is not particularly strong?
Well, I think we have the Korea partnership, which is ongoing in Saudi Arabia. We're excited about that. It's a great project, and I think we're expecting that to continue to actually gain traction as time goes on. But I think if you think back to what we talked about, our strategy being strategy from the core, our domestic operations, plus North America operations, I would say, with Canada and Mexico included, are the focus. We would like to actually focus in on that. And I think international in the short term, apart from the Korea opportunity, isn't a top priority for us. It's really the assets we have at this point.
So when we put this all together, thinking about the revenue enhancement opportunities, I guess, how did you generally think about the growth algorithm for Six Flags in a normalized environment, and how these investments could maybe push you above that?
Yeah, and I think if we go back to the growth algorithm, we talked about this on the February call, where we said once we get to the earnings baseline of 530 to 560 million, we expect to go to a situation where top line growth is expected to normalize at low to mid single digits growth. But because of productivity enhancements that we're actually able to make, we're able to grow EBITDA by mid to high single digits. And I think as time goes along, we see plenty of opportunity to drive that. And I think it's going to be definitely driven by both productivity improvements as well as revenue enhancements. And I'm really excited about this because I see a ton of potential. We really need to come out of the pandemic and normalize to be able to be much more specific about this. But every indication I'm actually seeing is it's tremendous value creation in front of us.
So let's move into the cost structure then, maybe a little bit deeper. One of the areas that I think that we wrestled with a little bit is that your operating metrics on various ratios, whether it's per visitor, per park, per employee, are already effectively best in class, suggesting you're doing a pretty good job on the, if not best in class job on the cost side. So what are some of the things that are maybe unique or structurally different about your parks and model versus peers? And then what do you think is maybe being done different that's propelling these metrics?
Yeah, I'd say I can't speak too much to exactly what the peers are doing specifically, but what I would say about us is if we go back to what we talked about in the Feb 2020 call, we talked about the fact that we weren't pleased at the level of the guest experience that we were delivering, and we wanted to enhance that guest experience. Part of that included investments in asset maintenance, paint, etc. But part of it also included an investment in labor. And make sure that there's enough labor to deliver the guest experience that we'd like to provide. And so the algorithm that we actually have, which includes the 530 to 560 million dollars in EBITDA, includes an investment in labor, both from what we expected to have in 2020 pre-pandemic, plus on an ongoing basis. It also includes the pressure from wages that we expected pre-pandemic, and even now that we're seeing where there's a significant shortage of labor supply in the market, not just for us, but I think across all industries. And so all of that is contemplated. But at the same time, in transformation, one of the initiatives was the labor optimization model for seasonal labor. So we're looking at productivity improvements to mitigate some of those wage pressures, and that too is included in the 530 to 560 million. And I think I touched very briefly on the pressures that we're seeing recently, but I think back in April when we talked about it, we expected, because we'd actually been putting this plan together to make sure that we had our staffing in place, we were expecting that by Memorial Day we'd be in a much better place. To be candid, it's been a much tougher lift than we thought, and it's still not that easy. I mean, we're making progress every day. We're getting better every day, but it's pretty apparent that labor's hard to come by for many industries and for us too. But we're going to keep on going one step at a time and making sure that we're improving. But all our parks are basically open at this point, and we're operating all our parks. And so it's more a question of making sure that we get the labor to where it needs to be to continue to operate all our parks every day as we go forward.
So how are you mitigating some of those pressures, as you're referencing that it's a much tougher lift in some cases than maybe you thought? What are the things that you're doing to ensure that you can find the appropriate level of labor in the near term? And then as you think about further out, are you changing anything to make sure that you can source more labor for future seasons?
Yeah, I think in the short term, what's happening is schools pretty much are beginning to give out at this point, right? And a source of our, say, a labor supply are school children who actually have their summer breaks. That valve is basically going to open up, we believe, in the next few weeks. And so if that valve opens up and delivers the amount of supply that we need, it mitigates the situation to a great extent. If it doesn't, I think we'll have to make some choices in terms of how we actually deliver the kind of experience that we want, that we would love to deliver to the guests. But I think based on historical approaches on what happens with school kids coming out of school, we found that it's a pretty good source of labor. And so, but it remains to be seen what happens because we're in a pandemic environment. So we're not quite sure until we actually see it manifest.
As we're coming up on the time, I guess I'll sneak one more in, which is just on, you referenced strong in-park spending. Are you seeing any big trends, on a regional basis? And are you thinking about, the impact, the flip side of the labor shortage maybe easing as unemployment benefits come off? Does that also factor into how you think about stimulus impacting your business and in-park spend and what's sustainable?
Yeah, I think definitely the flip side of the season of the labor shortage is there's more money in people's pockets, which is why some of them may not be coming off the sidelines to seek employment. That's going to be increased share of wallet, and you probably see a higher propensity to spend, and that's probably going to be in the numbers that we will see. The key over here is some of it may be short term, but some of it may or may not be short term because we're changing the guest experience as we go. We're changing the assortments that we're offering in parks as we go. And so there's a greater reason to spend than in the past because we've changed that piece of it. And so I think it's going to require us to kind of get through the entire summer, take stock, evaluate how much of it really came from incremental assortments, how much of it came from just higher propensity to spend, and then kind of sift through the details to see what sticks, what doesn't.
That's great. I think that's a good way to wrap things up. Sandeep and Steve, thank you so much for the time, as always. Hope to see you soon here in New York or otherwise out at the parks or at your offices, as I'm hoping that this will be in person one way or another in terms of meetings and our conference going forward. Thank you.
Thank you, Steve.
Thank you, Steve.